In Canada, there are jobs that offer defined benefit pension plan. One of the most common questions is when you leave that job, they often give you the option to commute the lump sum value or stay in the plan and take the long-term guaranteed pension income. So in this video, I want to go over some consideration that you may want to think about so then you can decide which option is better for your retirement plan long run. Welcome back to the channel. This is Jacky and I'll be taking you through different Canadian financial planning concepts every week. Now, before we jump into it, make sure you like, comment, and share this video. And if you haven't already, make sure you join our free private Facebook group where we have almost 5,000 members. In there, you can ask extra questions and also get additional contents. Alright, without further ado, let's dive into today's video. Now, before we jump into the detail, I just want to preface to say that whatever I'm about to share in this video, it's more for a rough idea and concept. It's not meant to be an extreme detailed calculation. So this is more suitable for smaller commuted values around 100 or 150,000. If you're facing a decision on a much larger pension plan like the 3, 4, 500,000 kind of size, and you want a very precise answer, you should consult an actuary where they will go into a much deeper consideration and calculation to give you a very, very exact answer. So if you're in that boat, then you can take what I'm saying today just as a consideration, but don't let it dictate your answer. You should consult an actuary if you're in that size. All right, so let's dive into it. And first, let's identify what plan we're talking about, because there is actually two types of pension plan being offered in your work sometimes. The first one is a defined benefit, and the second one is a defined contribution. So we're not going to be talking about a defined contribution plan. Instead, today will be just on the defined benefit plan where a retirement income is pre-calculated and it's a guaranteed thing. So before we go into any calculations, let's talk about some pros and cons of each choice. Starting with a retirement income, the pros are as follows. Obviously, you get income for life and it is guaranteed. No matter how long you live, you can live until 110 and you will be still getting those income. You also get to skip your investment choice because you're basically offloading that choice to the pension company. Now, another pro is that income is actually taxed every year as you start receiving those incomes. So in a sense, your tax is actually spread out over a long time. So your average tax should be lower. And lastly, very importantly, most pension plans are indexed to the CPI inflation index. So what that means is if we face a year like now where CPI inflation is like 6, 7, 8%, your pension plan will be getting that kind of indexing. Maybe some have a cap to it, but you will at least get some of those indexing. Now, not every single defined benefit plan will have. Some actually started to remove it because it's getting very difficult and expensive to fund these kind of plan if it's indexing to inflation. So make sure you check your most updated pension statement, and every time they give you a notice or update or letter about your pension, pay attention to it so then you don't miss out. You started with some indexing and now maybe there's no more indexing by the time you're retiring. Now, the downside of taking an income are as follow. There is really nothing left when you die. You only get the income. Some pension plan will give you something called a guaranteed payment period, maybe 10 years. So what that means is if you were to die right away after you start, your family will at least get 10 years worth of pension payment before it ends. Another downside to this is that if real inflation, because a lot of time people say, well, CPI is saying 2%, but that's bullcrap because I walk into grocery store, it's way more than 2% this year, then the indexing may not help at all because you're still falling behind due to real inflation. Another con for income is that there is really no chance for a higher income. You are getting what you guarantee and that's it. And last con is more hidden, but it's also a big one, is employer insolvency. So like I said, funding a DB plan can get very, very expensive. So sometimes if your employer is smaller, mid-size, you may want to pay attention to their insolvency. Like, do they have enough fund to keep funding these kind of pension plan? Now, usually most people's pension are either with a mega corp or what we call multiple plan provider. So it's a lot of different pension roll into one. Those have a lot less chance to face insolvency, but nevertheless, this should be part of your consideration. Now, moving on, let's talk about lump sum. Here are the pros. Number one, you do have total control over your investment because they just give you a lump sum. So you do also have possibility for a much higher return thus giving you a much higher retirement income by the time you hit retirement. Number two, and I would say one of the biggest pro is that if you die, just like any other investment, whatever lump sum is left over goes to your family or your spouse. And lastly, you do have some sort of flexibility to use some of the lump sum if you run into emergency. This is called unlocking the plan, which here I'm not going to talk too much on, but later in other videos I can talk more in depth of how you can unlock your pension plan. However, taking a lump sum also have its own cons, and one of the biggest cons is that some of the lump sum, if it's too much and not everything can fit inside your locked-in retirement account, your LIRA, then there is a big portion potentially that can go as cash. And if you don't have enough RSP room to roll that over into an RSP, then all that cash extra will be taxed right away. And you might face a huge tax bill, which also lower your total lump sum on hand that you can invest with. Next con is that with higher control and possible return, also comes potentially a higher volatility and unpredictability. And sometimes, very rarely, some pension plan also comes with health coverage on the side, and by foregoing the pension plan, you may also be foregoing the health coverage and benefit that comes along with it. So again, if that is the case, make sure you check your pension booklet before you make any decisions. Now, for some people, just hearing about the pros and cons are enough for them to make a decision right away. For others, it might be a little bit harder, so next we might have to look at some actual calculation and numbers. So today I want to take you through two different examples, each requiring a different types of calculation. The first one is going to be a lot easier, straightforward. It's more like a rule of thumb, while the second example will involve a little bit more calculation. So let's start with the first scenario where you're retiring right now and it's a matter of taking the lump sum right now or taking the income right away. So for this to happen, usually this will be around age 55, especially for occupations like police or nurses. There is a very fixed amount of time you have to be working, and then you have to make that choice because any time after that, you will only get the retirement income and not the lump sum offer. Now, in this case, because you are taking either income or lump sum right away, it is a lot more straightforward. And there are really two major questions you want to ask yourself. Number one is your health and life expectancy. Because of the fact that you're around 55, usually when this is offered, you are likely to have a much better tell on your current health situation, which will give you a very good hint on what your life expectancy might look like. By taking the retirement income, you're not going to get any lump sum when you pass away. So if poor health, shorter life expectancy, maybe your family have some history there, then really consider doing a lump sum instead. Now, if health is not an issue or you're not quite sure, then next we can look at something called 6% rule, which is often quoted in different articles or forums. So here, instead of doing very detailed calculations, we can just ask, is the income being offered us today roughly around 6% of our lump sum per year? So for example, if we're being offered $1,000 a month right now, or we can take $160,000 as a lump sum. We can simply take 1,000 times 12, that's 12K a year, which will equivalent to about 7.5% of 160K. Now in this case, because it is higher than 6%, according to the 6% rule, this person should lean more towards taking the lifetime income. The reason why is because achieving a 7.5% here for rest of your life, it's a pretty difficult thing to do, especially when you're retired. You probably are going a lot more conservative. So if they're giving you 6% or higher, you should probably take it instead of trying your luck in the stock market. And keep in mind, like I said, if the pension is indexed to inflation, then it's even better. Take CPI, for example, if we assume it's going to be a long-term 2% a year, and in our previous example, the income starting is already 7.5%. If it's indexed to CPI, your real return from this pension plan is more like 9.5% because you add this inflation on top as well. So that makes it even more compelling to take the lifetime income over the lump sum. Again, assuming your health and life expectancy, there's no clear sign that it's going to be much shorter than other people. All right, so that's very straightforward. Next come a more difficult scenario where you're being offered this lump sum or retirement income much earlier before your retirement. So this usually is for much younger people. You're changing jobs or being laid off and you're being offered this lump sum versus retirement income, but the income doesn't come until you're 55 plus. So here I'm going to use one of my previous clients' example just to work with some real numbers. So this person, let's say she's 44, she is quitting her job, and now she's being offered the following. Either she can take a lump sum as follow a little bit over 100K, or she can stay with the pension plan, not have the lump sum, and starting at age 55, she will be offered $668 per month. Now, keep in mind this pension is right now indexed to CPI inflation. Now, just as a side note here, you're going to notice two different numbers. The first one, the top one with a much bigger number, is the amount that will go into a locked-in retirement account LIRA. This can happen tax-free. The second portion is going to be cash, and if you have the RSP room, you're going to roll this into RSP. If you don't have it, it'll be added towards your employment income for that year and be taxed there. So now the question is, should she take 105K right away as a lump sum, or wait until she's 55 and start the $668 per month? Now, if you try to do some math right away, you're going to very quickly realize this is a formula, a question that can't be very straightforwardly solved because there are too many unknown variables. For example, we don't know what the inflation number is going to be on average. We also don't know our average return, and we also don't know our life expectancy. Now, there are software online or out there that can help you calculate these things where you just plug in everything. But often I find that you either have to pay a lot of money to get access to them, or they're free, but they have some very strange limitation. For example, the one that I try to use does not allow us to put our current age as 44 and getting the lump sum. The earliest we can start are age 50. So this calculator I really can't use to help my client. Now, if you're in this boat and none of the online tools can help you, then you can do what I'm doing right now, which is coming up with very simplistic calculations to give us an idea what kind of return or expectation we're looking at. So basically the question I want to ask here with my client is, if we take the lump sum here right now, what kind of return we need to get, how well do we have to do in the market, so then we can replicate a very similar thing by the time we're 55 and still get the $668 per month for the rest of our life. So the first step here, what I like to do is always draw a line and just visualize how many different stages of pension income from now until we die do we face. So here we really have two stages. First one is from 44 to 55, where we're not getting anything, we're just growing our money right now. And second stage is from 55 until we die, we're gonna get that 668 per month indexed to inflation. Now, so for some people, you might have three stages. If you're gonna have something called bridge benefit, which is gonna start from 55 to 65, this is where they will pay you a higher amount for those 10 years because you haven't started your CPP yet. So they're gonna try to give you that bridge, and then when your CPP starts, they can lower that amount back down to the actual pension amount. Now, once you draw your stage, next what I want to do is go into my Excel and really just come up with very simple formula and assumptions that kind of replicate the visualization I just did in stage one. So as you can see on the screen, this is exactly what I did. I came up with kind of like a table where I have different years from now all the way until age 100. And then we have different columns like lump sum, return per year, retirement income, average inflation per year. And here what we want to do is just plug in all the numbers we know for sure. For example, we are starting with 105,000 lump sum. Now we can also put in 668 starting at age 55. That's what we're promised. Now monthly is going to be a lot more accurate. That's actually what you're getting. But for here, I'm going to make things super simple, and I'm just going to put an annual amount, which is about 8,000 here. Now for average return or inflation per year, this is something we don't know, but we can just put something as a placeholder first. Let's say 5% return and 2% inflation. These are the two boxes that we can change constantly to get different answers. And then next is really just come up with very simple formulas that can replicate the growth of our investment account and also take into account the indexing of our retirement income. So as you can see, basically what I'm doing is taking the lump sum, make sure it is growing at whatever interest rate per year I gave it, and minus the retirement income that I'm expected to get, which will be 0 early on, and then starting at age 55 will be 668, and then higher and higher every year depending on the inflation number. All right, so here basically we have a basic formula, and you can see that, take for example, let's say I change the return to 4% with a 2% inflation. If I do die at 75 years old, according to this very general calculation, I will be left with a lump sum. So in this case, I'm actually better off doing my lump sum because in my pension scenario, I would not be getting this lump sum when I died. Alright, so now with this, instead of entering different variables of return and inflation and try to, trial and error, what I like to do finally is I like to create a very simple table of life expectancy versus inflation. And in the center, I'm going to plug in different return I need so then I can get the exact same result as my pension plan. And how I'm going to do this is, if you're using Excel, there's a very cool function called goal seeking or seek goal, where you can tell the Excel what kind of condition you want to set, and they will tell you what kind of number you need to come up with in order to hit those conditions. So for example, let's say I expect myself to die at 73, and my inflation is 2.1%. I'm using this because CFP guideline right now is asking us to use 2.1% as an average inflation. Basically, what I want to tell Excel is, hey, if I'm dying at 73, what kind of return do I need? So then at 73, my lump sum will become 0. So tell me that return I need. And in this case, Excel told me my return is 2.81%. So on average, if I can get 2.81% starting today at 44 until I die at 73, and I'm drawing the exact same number as I do versus my pension plan, I should be left with exactly nothing when I die. So in other words, as long as I'm confident that I can get more than 2.81% a year starting today until I die at 73, I would be better off taking my lump sum instead of my pension plan. So what I can do finally is just enter a different inflation number that I want to check with a different life expectancy, seek goal and make it 0, and then just to get the minimal return I should be looking at. So in the end, we'll have this table, and basically it gives us a range of return that we should ask ourselves, do we think we can do this kind of return or better when we're deciding lump sum or income? If the answer is yes, then take the lump sum. If the answer is no, or I'm not comfortable trying to chase this kind of return, then you should take the income. Now again, keep in mind, no matter the method you're using today, the answer you're getting is very, very rough and only meant to give you an overall idea or concept of how difficult it is to replicate this retirement income you're about to receive many years down the road. But generally, I think that if your time frame before you start taking retirement income is 10 years plus, usually you have a very good chance of growing your lump sum to a point in 10 years that can outdo the retirement income you're being offered. But as always, consult your financial planner, advisor, CPA, or even an actuary if the lump sum you're being offered today is a huge amount and you want very exact answer. Now that's everything I want to share today. If you like what I'm saying, make sure you hit the like button once. If you don't like it, make sure you hit the dislike button twice. Next one I want to hear from you is, how do you decide should you be taking the DB pension later on or the lump sum right away? If you have other methods or you have friends or coworkers facing these kind of problems, let me know in the comment down below. I want to learn how you are doing things. If you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you subscribe to the channel, click the bell button to get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next video. Bye.